Good morning there, well-pressed viewers and subscribers. Welcome to another Monday morning roundtable. This week, as usual, we have Jeff Zananieri and Roger Scott. Joining us for the first time is Kip Harridge. Kip, welcome.
Thank you very much. Great to be here.
You bet. It's great to have you here. And Roger and Jeff, welcome to you too, as usual.
Thank you.
Thank you.
Great to be here.
Okay, gentlemen, let's get started. We've seen quite a number of market data points that are worthy of conversation. Gold has broken through its last record set in 2011 of $1,920. Moderna jumped 8% today. Intel's delay in its microchip has been a boon for Taiwan-based TSCM?
Taiwan Semiconductor, yeah.
There we go. Yeah. So let's start with you this morning, Jeff, since you happen to be right next to me in the lineup of pictures on Zoom here. What's the driving sentiment for you this week in trading?
Well, so we spoke last week about gold, and I'm not a gold bug. I'm always saying that. I'm always putting that on the forefront. I'm like a make money now bug. And I saw this volume come in. I saw the dollar move starting to really accelerate on the weak side, and that's been a big boon. And now we're breaking out at all sorts of technical levels. Roger and I had a follow-up conversation last week where we discussed silver as well as gold. And a lot of people are thinking that, we've had a nice run and this is the end of it. And I'm starting to think, well, this is the takeoff point. This is the launching point. That's why I'm like, I was waiting for the launching point to get in again. I've traded like serially because I like to swing trade. But a thing to watch is we had some real distribution days at the end of last week in technology stocks in the US. We had all the FANGs down 4% on Thursday to 5%. Microsoft had the biggest earnings quarter they've ever had, and the stock got whacked. So tech stocks are priced to perfection. We're still in earnings seasons. We've got a lot of earnings this Thursday. We've got Facebook, we've got Amazon, a lot of big ones to look out for. But we also have Caterpillar, Boeing. So we have some old economy stocks, if you will, this week. So keep your eye on gold. The dollar is important because the dollar is breaking down like multi-year levels. So if that cascades, you're going to see gold really go. And for a little while, it's been a boon for stocks, but I think it might start to create a little bit of panic. Something to pay attention to.
Okay. And you, Roger, what are you following this week?
Well, this week is a big week. We've got major events. We've got FOMC this week on Wednesday, and we have GDP on Thursday. Typically, when you go into weeks that have GDP and FOMC, the markets tend to be quiet in the beginning of that week, and then they tend to ramp up when the news comes out. So I'm not expecting large institutional bets, directional bets, till after the FOMC comes out. Now, with that said, most traders know what the FOMC is going to say. They're not going to do anything. They've locked themselves into a corner. We've all talked about that many, many times. We know that they're not going to really do much with rates till the end of 2022. Which is why the residential real estate market has been rallying. So I think the biggest catalyst this week is going to be GDP. GDP is a complete question mark. We went from positive 2.1% to negative, I think last quarter was negative 5%. Now they're expecting negative 35%. 35%. So I think a combination of earnings, ill response from the tech sector, more defensiveness rising, and volatility towards the second half of the week is the key. We started seeing, beginning of last week, technology not responding to good data. As you guys know, I've been talking about the same momentum levels that are near historic overbought levels on the technology sector. So right now, I'm looking for more defensive stocks like basic material stocks, home builders, home mortgage stocks to rally. I'm looking at consumer staples to start moving higher, and I'm looking for metals and bonds to and potentially move above their current level, and more weakness in the stock market. But that may have to wait till the second part of the week because of how the week is structured with Fed data.
Okay. And Kip, give us an outlook from your perspective.
Market's broadening, James. We had all-time highs in the NYSE advanced decline line just last week. That confirmed the previous NASDAQ breakouts to all-time highs, and we had the S&P 500 top the previous June 8th highs. That had not happened yet. That happened last week. So these are all confirmations for us that this market's broadening. and the wall of worry move higher is probably going to continue. And we are big time bullish on the miners. This group is completely still underinvested in. I mean, industry pros have positions, but the public knows nothing about this group. I run regular surveys with both on Twitter and among my members. And as bullish as we've been on precious metals and the miners, very few people own this group. This has the look of what could be a melt-up move higher.
Mm-hmm. Do you think that the sort of absence of uptake in the gold market suggests a little disbelief? Do you think that's a result of the sort of the singed feathers that occurred after the last gold bull run we had from 2002 to 2012-ish, we'll call it?
Yeah, you know, it was that melt-up move higher from 2008 to 2011 that got everybody in, and then then we had an eight-year bear market, and
Right.
it just brutalized people. You know, it was brutal for anybody involved, and you kept thinking there's just no way this group can keep going down, and it did. So it got completely washed out. Investors have yet to come back to it, and look, we have $11 trillion in global liquidity, QE and stimulus so far in 4 months. That's the story. That's the story.
So Jeff, you made a good point last week about the teaching moment, where it is not necessarily auspicious or correct to believe that it's got to be one sector and one sector only that's experiencing a positive sort of period. And I think today's data I'm looking at just confirms that. I mean, Tesla's up 4%. Gold is up, obviously, into record territory. The biotechs associated with the virus are flying, and even the 30-year bond yield is up very slightly. But so it's like it's an embarrassment of riches here.
Well,
again, just like last week, the challenge for the individual investor with a finite capital to distribute into that opportunistic landscape, what are you going to tell them?
Well, I'm so happy that you have the memory that I'm not blessed with at this point. My short-term memory is totally effed, if you will. But I did say that. But the thing is that what you really have to realize is that it's the same fundamental reason driving these things to have parabolic moves. And Kip alluded to it. We had a money supply, we had an M2 growth of 30%. Like, you could look at a long-term chart of that, and you've never seen the money supply explode like we just had. We have a liquidity event that we've never had in the United States, globally, but specifically in the United States. So there's a lot of dollars sloshing around and not a lot of attractive things to buy. And so people in the stock world are buying protection for their money through the form of gold. And as Kip alluded to, and I know you've been talking about this, James, for months, the miners are undervalued for what they do, for their assets, for their inventory, for their prospects. But technology stocks from that standpoint are not undervalued, but you have to see that there's a premium being paid for their viability into the future. And because there's all this liquidity chasing fewer assets, you're going to see these dislocations, these distortions, I think, just get more extreme. Because the have-nots are under pressure, like existentially. Should these companies exist? Should the movie theater business be a business? These things are big questions being asked of the economy, of the stock market right now. But we do know that there's going to be gold, because gold's been around forever, and we have a pretty good idea that there's going to be an Amazon, because they're crushing it. What would we be doing without an Amazon delivering everything right now, right? So those two things can be true. You can be a tech bull, you can be a gold bull. I certainly am. And I just think you have to be really cognizant of what your timeline and how your trading style works to time in to these things.
Mm-hmm. And that's the challenge, I guess, for a lot of people. Roger,
and I just want to, I want to,
the housing side last. Oh, sorry, go ahead.
Well, before you ask me that question, I just want to interject to something that Jeff, that you guys are talking about right now in terms of the technology. Just to clarify, not every part of technology is seeing that crazy move. The cloud computers are seeing it. The stocks, the technology companies that are benefiting directly and indirectly from the stay-at-home economy are moving up. but that's only about 30% of the tech companies. If you look at, for example, Western Digital, traditional hard drives, they're out. I mean, everybody's moving to the cloud. So you have the big cap tech stocks, the ones that are going to be benefiting the stay-at-home economy moving higher. But if you look at the smaller, or if you look at some of the semiconductors, and if you look at some of the storage, they're also starting to break down. So I just want to clarify further, it's not all tech, but there's a lot of good tech that's going to keep that price higher. And I think as the further we go down this road that we're on right now, the more we're going to see that differentiation rear its ugly head, so to speak. You're going to see that difference between the chips and the cloud computers versus the traditional memory or some other traditional companies that are in technology that are not being benefited by the stay-at-home economy. So it's not all tech, but a lot of tech, yes. Sorry, go ahead. I didn't mean to cut you off. I just wanted to clarify that part.
Sure. Yeah, no, you made that point a few weeks ago as well, that there was a small number of companies in the NASDAQ 100 subsector that were actually that were the beneficiaries of 80% of the volume. And that's really kind of misleading, because people tend to start thinking that I can buy anything tech and not get hurt. So that's a good thing to keep in mind. My question for you was, though, just as Jeff was focused on this idea that you don't want to get caught up thinking that you've got to be in one sector when there's a lot of opportunity out there. You were very bullish on housing and derivative or associated subsectors of the housing market. And I've been watching your picks, and they played out just brilliantly. I mean, I wish I'd bought everything that you mentioned last time we spoke. So that trade seems to remain intact. And is that something that we should continue to take advantage of?
Yeah, and again, this goes in line. I'm sorry, I'm going to refer again to what you and Jeff were saying, because there was a lot of value what you guys said in terms of the fact that, see, for those of you at home who are listening, I want to clarify this, because there's a lot of value in something that you guys said. The fact that the stock market is right now not in a great place, investors, and especially institutional investors, they're being a lot more selective in which companies they're putting their money behind. And a lot of traders are thinking, well, that's not great because only 1 out of 10 companies is going up, or maybe 3 out of 10 companies is going up. But that's actually better, because you're finally now seeing the companies that are really being triggered. It's very difficult in a raging bull market to see which is a leader and which is a follower when market cap is just taking everything higher. But right now, because we are in this selective process, because we're trying to find the best stock and just totally avoid the bad ones or not the best ones, it's easier to see where the money flow is going. And in my opinion, and actually it's not my opinion anymore, it was my opinion till last week, but it actually came true. We saw 20% increase in new home sales. We saw 12% increase in existing home sales. This Fed is not the Fed that you want to play poker with. They are just telling us ahead every 6 months what they're going to be doing. They're not going to be lowering rates. They're not going to be raising rates. They're going to keep rates at the current levels till 2022. This is the best time to refinance. When people refinance, basic materials. Friday, I have a CSI scan that you guys know about. I've told you about it many times, that I use 6 month, 3 month, and 1 month. Up till last Friday, on the 30-day mark, basic materials was outperforming everything. As of this morning, on a cumulative index, it's outperforming everything. That's the first time that's happened in about 6 months. So now technology is not on the first spot on a cumulative basis as well. This is very strong. This is very relevant and very strong, because my CSI scan tends to give signals for a good long period of time. So the point being is, basic materials, everything that's being benefited by the housing market and all the accoutrements that come with a new housing market. What do people do when they buy homes or when they refinance homes? They do their lawn care, they repaint their homes, they buy more lumber. Weren't we talking? You were telling us last Friday, you were giving us this whole thing about the deck that you were going to, you're going to push back your deck because the wood is costing 3 times as much.
Yeah,
It
I
go-
can't get pressure treated lumber right now in the dimensions I need it without paying a big premium, which upsets my entire budget. So yes, that's correct.
Exactly. So guess what? There's a company. I don't have the. I think they're called Trex. They make material to make artificial. This thing that you wanted to build, they make it out of artificial wood. So it's very treated well for. They make decking, but they do it so that they last for a lifetime. Okay, the
Oh,
material.
right. The synthetic composites.
Yes, that's it. That's it. That company was one of the companies that I gave out Friday. It's looking great right now.
Yeah.
So everything that has to, but here's the biggest part of it all. You see, usually 95% of the time, and I'm sorry I'm taking so long, but this is really relevant to the current environment we're in. You have stocks, usually in the real estate sector, you'll have a good mix between commercial and real estate. Well, no one's putting money in commercial real estate right now. That part is dead. So even REIT investors who had money in long-term commercial real estate are now moving into residential real estate. So you're seeing not only the residential market grow because of interest rates, you're also seeing it because of the lack of the money that's moving into traditional commercial real estate. And as most of you guys know, that the price of commercial real estate versus residential real estate, there's a big differentiator there. So that's even a bigger fuel for the fire in residential real estate, because you're going to have a lot of these REITs who are sitting on the sidelines, who have nothing to do, who are going to start moving into apartment buildings that they would never, ever in a million years look at, but for this COVID-19. So it's low interest rates, and it's the fact that you have all this commercial real estate money sitting on the sidelines with nothing to do. So I think these two factors are going to put more pressure or more buying pressure into basic materials and residential real estate and everything related to those two sectors.
Sure. Kip, we're getting close to the end of our session here, and the audience might not be familiar with you and your service. Why don't you give us just a brief thumbnail of the subscriber services you provide, and then sort of encapsulate that with a summary of the approach to both taking advantage of the situation in the market and protecting yourself from downside in the market ahead.
Fantastic. I started the VRA, Vertical Research Advisory, in 2003 after leaving Wall Street, where I worked 15 years. And, we have two services. We have our primary portfolio, which we've had since 2003. We also have an options portfolio we call parabolic options. And we've had 11 programs of those so far. Those are our two programs. My son is my partner. We run it together. He's in Austin. I'm here in Sugar Land, Texas, just outside of Houston. And, we like growth stocks. That's our thing. You have a buy on Patriot One. Guess what? So do we. It was funny that I found out we had that in common, because I'd seen your recommendation.
Right.
I recommended it just after the Las Vegas shooting. I saw him on Fox News, and anyway, so we have a bit in common in the way we find growth stocks.
Yeah.
So that's really what we do. We find growth stocks. We like to invest in industries that have an opportunity to grow for the next 6 to 12 months. We have our VRA investing system with 12 screens that alert us to what industries we should be in. And I'll just give you a quick heads up on what we're moving into now. This will be our next move. We've been very heavy in precious metals and miners for the last 2 years. And our next group is going to be, we think this rotation that Roger is talking about is very real. Again, led by $11 trillion in stimulus. And we think the next groups, because coronavirus is burning out. We have great sources at Baylor College of Medicine and Texas Medical Center here that tell us that they see all the evidence that coronavirus is burning out. We believe that after the election, it will officially end. It will be over. This is more of a political thing at this point than really it is much of anything else. That's just our view. Maybe that's a topic for another time. But with that in mind, we believe that the groups that are going to double probably into year end will be the airlines, casinos, and airlines, casinos, and hotels. So those are our three groups right now that we're looking at for a new addition to the portfolio. We think this market will continue to broaden, and that this is really the birth of a new bull market, that our shortest recession in the history of at least the United States is over, and that don't fight the Fed, don't fight the tape is really all that matters at this point.
Hmm. Okay, so Jeff, let's come back to you. Wrap it up for us. What's the overarching parting comment for the week?
It's a chop fest here. I mean, there's been so many false. I can't tell you the amount of people that have tried to play the turnaround on the airlines that get their face ripped off every third day or every, like I just think that it's a treacherous market. You got to be extremely selective. Roger made a really good point in that it's not all tech stocks. What I was talking about when I said tech stocks was I meant growth. Like people view gold as a defensive thing and growth and gold as being at odds. And I was saying that because you're having this money destruction and you have this massive amount of liquidity sloshing around, you're going to see both get chased and continue to get chased. Within every sector, even in technology, there's winners and losers. Chips are bad if you're Intel. If you're AMD, chips are amazing. If you're NVIDIA, who's now one of the biggest companies in the world, even better. So the bottom line is you have to do your homework. Don't fight the Fed. Don't fight the winners either. I have people that are like, "What is this too big a move in silver?" Nah. I mean, if you've been watching silver since the 80s, silver went from 5 to 50 in the 80s.
Right.
80s. So if you're fading silver on a dollar, you could get taken out back to the woodshed real quick with the quickness. So play with the trends, pick your spots to get in. Don't fight the tape. Don't fight the tape. Don't fight the winners. Don't be a hero. This is not a time to be a hero.
No,
Go with the rocket ships. Don't fight the
market,
rocket ships.
Exactly. Market has no use for martyrs. And Roger, how would you put a bow on all of that for our viewers this week?
I agree with Jeff. I would be very, very selective. I wouldn't be a hero. I think that's the quote of the week. Don't try to be a hero. Don't try to be a bottom picker right now. Don't try to guess what will happen next. If Kip is right and if airlines are going to make a big comeback, they will still be substantially undervalued when they begin to uptrend higher. In other words, you're not going to be too late for the party. You don't need to sit there and wait for the lowest low to hit. Your money will be sitting on the sidelines and you're putting yourself in danger. Don't stand in front of a freight train moving 100 miles per hour and guess where it's going to stop. Go with the flow. There's plenty of opportunities right now, metals right now, basic material stocks. But yeah, I'm with Jeff. I think we're going to have a lot of volatility. I think we're going to have a lot more earnings data that's negative. I'm not 100% sure if. Remember, even if we are done with COVID-19, it's not what we think; it's what the public thinks and the public sentiment. And that I'm going to just kind of sit tight and wait on the sidelines. But because I just don't know. I don't know what's going to happen. But again, right now, it's not a time to be a hero. This is not a time to load up on your favorite stocks and wait and see. We're in deep middle of earnings season. We've got two of the biggest quarterly reports this week, and I think we're going to be choppy with some more downside disappointments from the technology sector till we hit about the 50-day moving average or maybe even go a little bit below. But I think this is going to be a consolidated period, and especially beginning of the week, usually when there's second half big news, we're calm. So don't expect major moves and go with the trends.
All right, gentlemen, that's a great round of insight as usual. We'll leave it there for now. I'll look forward to speaking with each of you individually throughout the week. Gentlemen, have a fantastic trading week and we'll talk to you soon.